Oh, there's index funds, stocks, mutual funds, ETFs. What the heck do they all mean? In this video, you're going to get the simplest explanation to what index funds are, how they work, and how you can use them as an investor. The endless scrolling for answers stops here. So what is an index fund? Well, an index fund is a mutual fund or exchange traded fund with a portfolio of stocks that is created to match the stock market index. The most popular index being the S&P 500, which tracks the largest 500 companies in the US. And the most popular index fund is known as the SPY or SPY, and it actually copies the performance of the S&P 500. But index funds can be made to copy almost any financial market, sector, or investing strategy. Think of it this way. If you were to do the casting for a huge movie and you casted one superstar, you're paying them all the money you can, and if they're on, it's going to be a great movie. You're going to kill at the box office and you're going to look like a genius. But maybe they didn't get the right cappuccino, whatever, that morning, and they stink it up on set.
If you don't want to do it, walk away. I'll get someone who can do it.
The movie sucks because, you know what, they just didn't perform and there's no one else there to pick up the slack. This is what can happen if you invest in a single company or single share of stock. Now, imagine if you casted 10 really good actors, and even if one didn't perform their best on set, there was 9 other ones to pick up the movie and lift it up to still have a good performance. That's how index fund works, because you're spreading out risk across a bunch of companies and they're all held within the same index fund or pool. Instead of stock picking, market timing, buying and selling on demand, you're getting a diversified portfolio of stocks that go up and down based on the overall market. Warren Buffett, the OG, the Scrooge McDuck of stock investing, recommends index funds for people later in life, but he also says that you should have them as a passive investor when you're just getting started. And with index funds accounting for nearly $17 trillion, or roughly 18% of the overall stock market, they continue to gain popularity by the day. Now, they aren't sexy enough for day traders, but for the average investor getting into the market for the first time, or even somebody who has gotten in the market before but had a negative experience, maybe lost some cash, index funds provide a low risk barrier into the market. Here's a few reasons why index funds might be right for you. They provide instant diversification of your portfolio. Again, we're investing in a common big pool of companies, not one single stock. They are more tax efficient, meaning at tax time, you keep more money of your gains in your pocket versus paying out to the government, which is always a good thing. They have low fees, anywhere from $0 to $3 to $10 on every $10,000 you have invested, compared to mutual funds or ETFs, which could run you anywhere from $10 to $50 for every $10K that you put in. They're also highly liquid, which means you can sell when you want, you can buy when you want. It's not an asset that takes time to move like real estate or a business. And lastly, they provide a solid passive return over time. It's been 50 years since 1973, nearly, that they've had a track record of success, generating anywhere from 5 to 10%, depending on what the market performance is. On the flip side now, they are prone to market crashes. This is a con, right? They can go up and down along with the overall market. So if the market tanks, the index fund performance will go down as well. They also lack a little bit of flexibility. You can't just pick and choose what you want to include in your own index fund. That is done for you. What you see is what you get. You got to know what you want to have, know what kind of sector you want to invest in before you go and buy the index fund itself. There is an aspect of limited gains with index funds. There's a reason why day traders and kind of swing traders don't use them. It's because they're predictable and they're kind of a slow play, a long-term play. You're not going to generate 10, 15, 20, 30% returns with index funds. It's going to be a little bit more gradual than that. And the final con for index funds, there's no human element. You can't gain an advantage with chart analysis, with technical analysis. You're just basically saying, here's my money. It's going to move with the market. So there's no actual human element to gain or lose an advantage. That can be seen as a con by some investors who want to juice up their returns. Now, if you want to go buy your own index funds, all you have to do is figure out the tickers and then go to your trading platform and actually put it in order. The two biggest right now out there are the SPY, which you talked about, which is the S&P 500 index. And there's also the QQQ, which is the tech-heavy index, where it tracks all the big tech companies in the US. And you can buy them through your online broker or investing platform. All you need to do is punch in the ticker, buy and sell shares at your leisure. But just like a stock, you want to make sure you monitor the price and try to buy low and sell high. So before you go and pick your favorite index fund to invest in, I invite you to hit the like and subscribe button for the channel, and you can check out why and how stock prices move, including index funds, in this video right here.